Hello, and welcome to the Three Questions podcast, where we dive deep into the world of wealth management and connect you with industry experts. I'm your host, Wayne Baxter, Senior Executive Manager at One Capital Management. Have you or someone close to you recently gone through an insurance claim process and found it challenging? Well, stay tuned. Our topic, the three questions high net worth families should ask about the successes and failures of the insurance industry. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions podcast, please consider liking this video and subscribing to our podcast and YouTube channels. On this episode of the podcast, we're diving into the insurance industry, a cornerstone of financial security that protects billions of assets, but often frustrates consumers with claim delays and rising costs. So what's our topic today? The three questions high net worth families should ask about the successes and failures of the insurance industry. Now, for high net worth families, understanding insurance successes and failures is crucial, especially in the state of Florida, where homeowners face premiums averaging over $5,000 annually and more than double the national average. Now, here to unravel all this for us is Lee Burke. He is the president and founder of Burke Bogart and Brownell, and he is a 52-year-old firm. His firm is 52 years old, based out of Boca Raton, and he's renowned for serving the high net worth clientele in that area. And beyond that, Lee, across good parts of the U.S. as well. You're not just licensed in Florida, you're licensed in several other states as well.
About 30 states.
Yeah, and so welcome to the podcast. Great to have you. I think this may be one of the first podcasts you've ever done.
It is. And let me start off by saying that, we're here in Florida, and you mentioned we got 52 years experience. We have to do this really quick because the early bird's starting pretty soon, and I got to get over there.
Well, I told my director here, Jared Cook, I said, Jared, this could go on for a while, so keep an eye on the clock here. So we have now two reasons, Jared, for keeping an eye on the clock. Too funny. Okay, so one thing I want to bring up, even before we get anywhere near the three questions, is the fact, like, there's a lot of things we have in common. And one of them was related to our past and present life in Nova Scotia, Canada, my home province, where I was raised and spent many years. Now, I'm no longer in Nova Scotia, but look who's in Nova Scotia. You spent a fair amount of time there in Lunenburg, which is a beautiful town. If you've never been, to me, one of the nicest harbors you'll ever see in North America, too, by the way.
It is a gorgeous spot, and as you know, the Maritimers are absolutely marvelous to be around. Great people. The background you're looking at, I'm actually in my office in Florida today, but the background you're looking at is the inside of my home up there, which is a 240-year-old post and beam farmhouse. It's been expanded a little bit and modernized, but when you walk in, it just puts its arms around you and hugs you.
Well, I got to make, I'm not getting any advertising revenue here. We were just talking about the fact that I was raised in the Annapolis Valley in a little town called Bear River, East Nova Scotia. So, Lee, the next time you go to Nova Scotia, if you haven't been there already, I got two recommendations for you. I think I can make them, and I hope they're still there. But the Fun Day restaurant in Digby,
okay,
best scallops you'll ever find, and also the Digby Pines Hotel, which I'm certain is still there.
The golf course.
Yes,
Oh yeah.
I believe it or not, that's where we had my wife's and my honeymoon. And I persuaded her to go golfing on our honeymoon. And the second hole has this massive slope on the right-hand side of the hole. I hit the way up on the slope, and the ball almost went into the hole from coming down the slope. That's one of my memories. And my other memory is that she holed out on the last hole from off the green. I think that's the last great golf shot she's ever made for that note. But so Digby
Wayne,
Pines.
It might say something that your best memories of your honeymoon are a couple of instances.
I'd say it was the best memories. It's a memory of. Boy, did I ever put my foot in my mouth there? All right, Lee. Well, that's the end of the Three Questions podcast episode. All right. Well, let's carry on. You know, I know you're well known in South Florida, and I really don't think there's any real need to get into the history of the company, but I really what I wanted to spend my time on was just your thoughts of the overall insurance market in Florida. From where you're set, what do you think at this point are the biggest hurdles that high net worth families face when securing property and casualty insurance in Florida's market? And I say that especially with the issues around rising premiums and insurer pullback. So really interested in where you're seeing the insurance world in Florida right now.
Well, the insurance world in Florida has been a mess for the last 33 years. It's
Just
just
the last
really,
33 years.
yeah, well, since Hurricane Andrew, back in the early 1990s. And that's when the train went off the tracks in the insurance world in Florida. Um, Ever since then, it's just been what degree is the mess and what's the particular nature of the mess du jour, or the mess for that particular year. Um, you know, the mess today is better than it has been for at least the last 5 or 6 years. And that's not saying that there aren't serious problems. There are serious problems. There are serious issues. Certainly, among those are very, very high premiums, and to some degree, a lack of availability of coverage.
Mhm.
Um, and when you're a high net worth individual, you see and you experience these issues in a different way than John Q. Public. Because when you've got the high net worth, you've got options and you've got choices that don't exist for other people. And with those choices and options come a lot more responsibility. So the first thing I would say to the high net worth person is that when you're sitting down and you're looking at your risk tolerance and your risk appetite and how you want to handle it. And I say that rather than just addressing insurance, because insurance is only part of that process, and it really should be a relatively small part of it. Um, you have to look at the issues that exist in Florida, how insurance can play a part of the solution in handling that risk issue, and then get good professional advice and counsel, and sit and make good prudent decisions.
There have been some legislative reforms recently in Florida. For example, curbing litigation abuse.
Mhm.
I guess that'd be one of the bigger ones. I know, and maybe I don't know if it's too early to tell or not, but have these reforms significantly improved the ability for high net worth clients or clients in general when it comes to finding reliable property and casualty insurance? And if the
They're
and I guess I would ask, beyond that, what are the challenges that remain, given where we are?
okay. The the reforms which were passed in December of 2023, are in the process of making a big difference and a beneficial difference, to the middle market, of the insurance people. Pretty much, it's less of an impact on a high net worth client. And the reason being that in many, many cases, the high net worth client is either not using an insurance vehicle at all, or using it less than a normal person, or even a normal affluent person would, because they have the ability to self-insure or fund losses in another way. And the other thing is that they're generally dealing in a different level of the insurance market. There's a group of companies that we refer to as the private client companies, companies like
Hmm.
Chubb and Vault and AIG and Pure, and they cater to and serve the high net worth market. They operate in a different manner and really with a different set of rules and guidelines than the normal insurance market serving the vast bulk of the people. Um, the reforms that were passed in 2003 were aimed at curbing a lot of claim abuse and litigation abuse that existed in Florida. And that abuse was extreme. It was to the point where the, the the vast majority of the national name insurance carriers didn't want to do business here. We've got a active domestic statewide market that filled that void, but there are some real problems with that statewide market, that statewide domestic insurance companies. Um, and you know, there wasn't much availability of insurance, which is what part of what's caused the price to go up, because of a bad legal and social environment, and the legislation curbed a lot of that. Now it takes time for those changes to work through the legal system and to work through the claim expense. Um, but we're seeing those changes. Claims are way down, litigation's way down. There are more insurance companies coming into the market. Premiums have leveled off. They're not coming down yet, but they have leveled off, and the market is much better today in some ways than it was 2 years ago.
Hmm. Not recent. There's been a change to the
Yes,
better.
we really started noticing the change last summer. Once the insurance companies noticed that, I'm going to call them fraudulent claims, but are suspicious claims, were falling off in terms of claims being filed. That gave them the first indication that the legislation was working. Now, a year later, they're seeing where actual claim dollars and claim expenses are down, and that is causing underwriting standards to be relaxed. More companies coming in, more venture capital being put into the industry to take risk, and carriers are loosening up the purse strings to take more risk. And there's more competition now.
So, do you think that the new rules regarding, I'm thinking of condos here, with what happened there with the Surfside condo collapse, and the fact now that the government has really kind of put their foot down, I can say their thumb down, their foot down regarding condo associations having, the proper funding and doing the proper upgrades. Do you think that's had a favorable impact at all on the insurance? Is there any correlation there, Lee, do you think?
There's a little bit of a correlation, but I will tell you that the condo market, what I would call the condo mess, is much greater and much deeper than simply the insurance issues.
Oh
Uh,
yeah, understood.
the condo situation in Florida is really in trouble, and I personally believe it's worse than that the public perceives, and there's a lot out there in the public that the public's being told it's a real mess. I think it's worse than that.
Do you think it's more the older ones? It's not the new ones that are being built right now, the new developments. It's more related to the developments that were, 40, 30, 40 years old, the older ones that where the problems lie?
Well, the older ones have their own specific set of problems, and a lot of that deals with legislation that was passed after the horrific condo collapse in Surfside, where there was tremendous loss of life and an entire building went down.
Right.
That resulted in significant legislation with regard to repairs expenses, meeting
Exactly.
engineering requirements, mandates, and safety guidelines. And those changes are costing the older condominiums incredible amounts of money. I mean, it's not
Exactly.
unusual. It's not unusual in an older condominium to see owners getting assessed $100,000 or $150,000 for repairs.
I'm more than aware of it.
Yeah, and that's its own set of problems. You don't have those problems in the newer buildings, so it's
Correct.
a different situation.
Yeah, and you keep reading stories. I know there's articles in the Wall Street Journal recently about, folks having to basically give up their dream of living in South Florida and on the beach, because of these expenses, and they basically left with the option of, somehow coming up with, like you said, $120,000 or selling at a significant loss to get
Mhm.
out from underneath this financial burden. It's pretty terrible. Um, we're in the idea of this podcast, Lee, was to talk about success and failures in the insurance industry. And I thought a great way before we get to our three questions, was for you to share a time when you and your firm saved a high net worth client, for example, from what we'll call an insurance failure. So just an idea of a success story that you can share with us that sort of outlines and demonstrates your expertise.
Um, I'm going to share with you somewhat of a humorous story, if I may, and it's one of the ones that I love when I'm teaching a risk management class. I love to share. I call it the moonbeam claim story. Envision a oceanfront high-rise condo,
Yep.
and multi-story, expensive apartments. 400 apartments in the building. And on top of the condo is a tall cell tower. And on top of that cell tower is an aerial beacon with a lighted light for aviation safety purposes.
Yep.
And the security people in the condo association, um, at dawn or at dusk every evening, went up to the roof, walked out onto the roof, looked up to make sure the light was lit for aviation security purposes. And then they went back down to their post down on the first floor. So they were on the roof for, 30 seconds. Well, lo and behold, there's a workers' compensation claim that is filed from one of the security people. And he claimed that he was having medical effects. And and the security people were basically all senior citizens, which is very typical. And he was having medical effects. He was having, arthritis pains and some incontinence, and some of his hair was falling out, and little problem in the bedroom, and a few other things. And he claimed that it was from beams and rays, etc., emanating from the cell tower.
From the South Tower.
From the cell tower. Okay. Now, kind of no sooner had that claim been filed than two or three of the other security people filed similar claims. Now, it might have been purely coincidence, but the claims were all filed by the same small law firm about 200 miles up the coast, which, if I remember right, was a relative of the original claimant. That might have been a coincidence, but we'll chalk it up to a coincidence. The condo association, the board's reaction was, "This is ridiculous. This is frivolous. There's no way. We don't want these claims paid. Hell or high water. Tell the workers' comp carrier not to pay the claims." Okay, fine. We get involved. I get involved with the workers' comp carrier, which is unusual for an agent. Workers' comp is normally a self-actuating program. There's not much need for anybody to get involved in a workers' comp claim because it follows state statute. So we get working with the claim department. And the claim department comes back and says, "Well, we're really concerned that these claimants are elderly. They're not eligible. They're not going to get employed anywhere else. Um, we're scared that these could be big claims, and we're going to make a reasonable offer, fairly significant offer, to each of these people to settle." And the association board was furious
I
about that
can't. I
idea.
can't
They were livid. So they said, "No, no, go back, tell the carrier they cannot settle this claim." I said, "Well, okay, you can't tell the carrier they can't settle it, but all right." So I go back to the carrier, have a conversation with them, explain the board's position, and the carrier says, "Well, you need to tell your client that we have a legal obligation to settle workers' compensation claims. We just because a client doesn't want to pay it, that's in violation of the Florida law." I said, "No, I know that. I got that picture." They said, "We have to make a good faith effort to settle these claims." I said, "Okay." Go back, report that to the board. The board says, "Over our dead body, you tell them no." I said, "Okay, you really want me to do that?" "Yeah." "All right." So go back to the carrier, and I have to add, in the process, the cell tower had sent out engineers to check everything about the cell tower, and if there was anything emanating from the cell tower, the answer was no. The condo association did that. The phone company did. There was no scientific evidence that there was any issue. In addition, the claimants had provided no scientific evidence that there was any issue.
They just merely stated
It
that
was
was
all
the
this is
case.
all a joke.
It was.
So I went back to the insurance carrier and I said, "Guys, let me explain why you're not going to settle these claims." And they said, "We already explained to you that we're going to settle them. We have to settle them." I said, "No, you don't have to. And here's why. Because yes, you have an obligation to settle the claims under Florida law, but you also have an obligation to act on behalf of your client in their best interest. You have a de facto fiduciary obligation. I'm half playing attorney here, but I'm pretty good at half playing attorney. And I said, let me explain. You've got 4 claimants now. You have 600 residents in this building. And if the word gets out that this cell tower is creating medical issues, every one of them is going to be filing a liability claim.
They're all going to be up on the tower. They're all going to be up on the roof.
And every guest who has laid out at the pool in the last 6 months and read a book at the pool is going to be filing a claim. And Nancy Grace is going to be with her TV truck on the front door of this condo association, broadcasting that there's this sick building in South Palm Beach County, and the $500 million value of the condominium apartments in this building is going to go to zero overnight. And the condo association is going to bring a claim against your insurance company for the $500 million on behalf of their members for your bad faith decision to settle this claim simply because it was in your best interest. So guys, you're not going to settle these claims. You're going to fight them. You're going to tell that attorney up the coast to go stick it in his ear and call me when you get a result. And they ended up settling the claims, I think, for, like $2,000 nominal fee each one, and the whole thing went away. So, that was a situation where we didn't want a fraudulent claim paid because of the precedent it would have set.
So I guess the condo association was somewhat satisfied, given that $8,000 sounds a lot more realistic, although barely, I would add. $2 would have been a better number, but nevertheless,
Well,
I guess the insurance company feels good about themselves, and the condo association can say crisis averted.
Yeah, there had to be enough dollars involved for the attorney to get a little bit out of it. So I think that's
there
why
you
it was.
go.
Yeah. And by the way, it did include a resignation for all 4 of the employees. So there was nobody else going to be filing a workers' comp claim and losing their job for a couple of bucks.
There you go.
So
Okay, so we're discussing on today's podcast the 3 questions high net worth families should ask about the successes, and we just talked about one, the successes and failures of the insurance industry. And Lee, let's get right to the questions.
Okay.
Question number 1, and this one, you're not my first property and casualty insurance guest, and this one seems to always come up. Question number 1, I'm wealthy. Why do I need insurance? Lee, take it away.
You don't.
Yeah.
problem.
There we go. Answered that one easy enough.
You got enough money in the bank. You got enough asset protection. You've got your trust. You got your money offshore. You can hire all the most expensive attorneys in the world to defend you. If you want to thumb your nose at anybody that files a suit against you, and you want to defend yourself, and you want to take on that risk, and you just like fighting, and then some people that like fighting
have at it.
That's one of the luxuries you've got as being wealthy. That's assuming you don't have a mortgage or anybody.
I was just going to say, there's some bankers out there that would be debating that response, I must say.
Well, again, there's always the issue of somebody that has got the right to tell you you're going to get insurance. But in lots of cases, the wealthy either don't have a mortgage, or they've got their credit line with J.P. Morgan, and they can work around the insurance requirement. But in reality, the wealthy have some options that the rank and file do not.
Fair enough. So that my retort to that, and I didn't come completely disarmed here, is you just identified the fact that in theory they don't have to, but there are risks. Because what I wanted you to take a couple minutes to do is just share with us some of the specific risks that higher net worth families in Florida face that make insurance indispensable. Even those who do have, significant wealth. And, I'm thinking, off the top of my head, hurricanes would be one, litigation risk be another, but I'll let you sort of grab the ball here and share your thoughts.
Well, I think two big issues are the catastrophe exposure, which in Florida, we would consider primarily hurricane. In California, you've got your fire and you've got your earthquakes. Here, it's
Right.
it's hurricane. Um,
And
with
maybe
regard to the
rising water. We talked about that a couple of weeks ago, remember?
well, the rising water, which is flood, which again may be part flood, part hurricane. So it's those to some degree can go hand in hand. Um,
Fair.
but but one of the things that the wealthy person has to look at is, what level of exposure do they really want to take? Do they want to self-insure $1 million, 5 million, 10 million, 20 million? I mean, even if you have $100 million net worth, which is pretty substantial, it's probably not wealthy in today's crazy market, crazy world, but it's pretty nice net worth. You know, at some point you're going to holler uncle and say, I don't want to take more than 10, 15, 20, 25 million. I'd like to be a little secure. And then the issue becomes, okay, do you have a potential risk exposure over that? Now, I'll give you an example in Florida. One of the things that people don't think about, we're talking to a lot of clients, they've got a house that costs $10 million to rebuild. It's got a $20 million market value. And the client says, well, I'm going to self-insure the wind because even if I lose the house, I can pay the 10 million and I'm not worried about it. Well, I like to ask them, well, if we have that class 5 hurricane, how much do you think your lot's worth for the next 5 years? It's not worth the 10 or $15 million it's worth today.
That's for sure. And they're
You know,
doing
what
that
are the
now here in Southern California in the Palisades
yeah,
with those properties that now there's just a cement pad on the
yeah. What are those oceanfront lots that the Stars had in Malibu on the west side of the highway? Those can never be built on again. I mean, those $50 million properties just went to zero.
yeah.
And it wasn't the value of the house, it was the value of the land. Well,
Mhm.
that value of the land is impacted by a hurricane, by a catastrophe. People don't think about that. People don't like to think about risk. It's not natural to think about risk. It's not natural to evaluate risk. And that's one of the big shortcomings, of the non-risk manager. They just don't think about that. The other issue when you get away from the physical assets is, of course, the legal liability and the negligent situation. Um, and
Big time.
we of
Big
course
time.
think about automobile accidents, but go beyond automobile accidents. What do some of the wealthy do? The wealthy are board members. They're board members of charities. They're board members of nonprofits. They're board members of country clubs. You know, you're a board member of the YMCA or the YWCA, and you have a sexual abuse situation. Think back to the University of Michigan with Dr. Diddle, with all of the Olympic athletes that
Yep.
that were abused over how many years? I don't know what the final number was at the Michigan State University, but think of that happening at your local Y, and you're a board member, and you're sued. Well, that Y has probably got $1 million D&O coverage split up between 20 different board members. But you're the
That's not
deep
going to go
pocket.
very far.
Yeah, you're the deep pocket on the board, and there's $100 million worth of liability suits. I want an umbrella policy that's going to cover me for my activities as a board member of a nonprofit entity. I want that protection because I want to be on that board. I want to donate to them. I don't want to give up the board position. You know,
No, the
one of
good
the
thing
issues
about
that
umbrella insurance in general, and you be better to state this than I am, but in terms of actual dollars per coverage, it's a fairly inexpensive way of protecting yourself.
it's a very inexpensive way. I mean, typically you're looking for a $5 million umbrella might be a couple $1,000s a year. A $10 million
Yeah,
umbrella might be
exactly,
four or five
exactly.
thousand.
Yeah,
And if you've got the $100 million, it's just not an issue.
yeah.
The other thing is that, you know, what people will always say, well, how much coverage do I need? So one of the questions a high net worth client asks.
Mhm.
Well, there is no answer until you tell me the specifics of the claim or tell an attorney the specifics of the claim. You don't know. But my answer is always, you want to have enough coverage. So the liability insurance carrier will never tender their policy limits. Because once they write a check for their policy limits and tender it to the court, they no longer have the obligation to defend you. And the defense costs in an umbrella policy are unlimited. And the beauty part of it and the big chocolate icing on the cake with an umbrella policy or a liability policy is that insurance company is paying for the defense costs to defend you as long as that claim goes.
And
And
who
you
knows
don't
how
ever
long
have
that's
to
going to
worry
be.
about that.
And who knows how long that's going to be.
Yeah.
Yeah, I've seen cases where I know someone fairly close to me, professionally anyway, who they found themselves subject to a surprise accusation. And the issue there was, they had a fairly public position, and so fighting it, and because they probably would have won. But the problem was they were in the public. So the first question the attorney asked them was, "Do you have insurance?" And the answer was no. And so they ended up writing a fairly we'll talk about next time I see you, Leo. We'll talk about it offline, as they say, but that was a six-figure check
Yeah.
to
I,
make
I
it
will
to make him go away.
Yeah. I will tell you there are a few things in life that are less comfortable or more uncomfortable, excuse me, more uncomfortable than being a defendant in a lawsuit. And looking down the gun barrel, or up the gun barrel as the case may be, at plaintiff
If
attorneys
there's a gun
who,
barrel involved, I just don't want to be
yeah,
around.
you
Just
don't want to be anywhere near there.
let's just leave it at
And
that.
you're writing the check for your defense costs. It, it gets pretty uncomfortable very quickly.
Uh, Lee Burke's our guest here today, joining us from beautiful Boca Raton, and so we're going to go on to our second question. And we kicked this around, I will admit right now, a little bit. So I'm looking forward to the response here from you, Mr. Burke. So there's the second question of our three questions today. What does insurance promise but not deliver?
I love this question. One of my biggest frustrations, and I love our industry, and I think our industry by and large does a very good job. But the industry, I believe, very, very wrongly promotes a promise of protection. I mean, you watch any TV ads, and everything is about protection. Whether it be life insurance, health insurance, auto insurance, homeowners insurance, they're always talking about, the protection you're going to get. Insurance doesn't protect you against anything. If you have auto insurance, are you protected against having an accident?
Not at all.
If you have homeowners policy, you're protected against a fire or a hurricane or somebody slipping and falling in your pool? No. It doesn't. If you have health insurance, are you protected against getting sick? I don't think so. It doesn't protect anything. And I will tell you, the first 25 years of my career, if you asked me, I would have said protection is insurance is protection. And I was getting mentored one day, about halfway through my career, and my mentor looked at me and said, you're a reasonably smart guy, but you don't know squat about what you're doing. Insurance is not protection. And I can say squat, correct? Yeah, I can say squat.
Yes,
Um,
it.
yeah,
Well,
okay.
it's fine.
He said, insurance is not protection. He said, insurance is simply a tool to finance risk. It's a finance tool. Well, I love that answer because I'm a finance guy. I got a finance background. And that's what insurance does. It is a tool to finance risk. Now, there are lots of other tools you can use to finance risk. And when you're wealthy, you have a whole slew of tools. So you don't need insurance. You can finance risk other ways. But people need to realize that insurance doesn't protect you against something bad happening. It's a contract that lays out certain obligations. You pay a premium, the insurance company has an obligation to pay you to effectively finance certain types of risks that happen to you. And that makes all the difference in the world when you realize that, because the expression I use is the gods of risk don't care whether you have insurance or not. If
Mm-mm.
something bad's going to happen, it's going to happen whether you have insurance or not.
That's exactly why you need to have coverage.
Or make a thoughtful plan on how you're going to manage that risk and finance it.
Right. So I guess that my follow up to that then would be, how do I get what I want then? Like, I mean, you're saying that, it doesn't offer protection, but I want to be protected. So how do I get what I want?
You know, the answer to that is, first of all, sit down with somebody that's experienced, that is a good communicator, and they're going to look at you, and one of the first questions they're going to ask is, what is it you want? What is it you're trying to do? What are you trying to accomplish? What are you trying to what are you trying to avoid? Let's talk about what the objectives are, what the goals are, what we need to do to get you where you want to get to. Because again, people think they're buying protection, but they're not. They're trying to avoid or limit or control or manage a financial risk. Okay, how are we going to get there? And again, is insurance the right way? Or is spending $50,000 to put a new roof on your house rather than a 30-year-old roof, which is going to blow off as soon as we have a little wind, is the right answer really putting a new roof on your house where your family's safe at least in a regular storm? You know, it's sitting down and deciding and talking about what the goals and objectives are, and then you can plan what you want to do insurance wise, other safety ways, risks that you want to avoid. Lots of planning and lots of getting where you want to be is simply avoiding risk. Simply, there's nothing wrong with simply saying, I kiddingly use the expression, but I also would never do it. I don't fly on a Russian airline. I just don't like the idea of the risk flying on a Russian airline. Not doing it.
Noted. Um, you know what? I was gonna, I was gonna ask, I'd planned to ask you about how the, how does this year look? I think we kind of covered the outlook for 2025. If you want to just chime in real quick, before we get on to the third question, I didn't mean to segue off our topic too much, but just for this, do you see for the families in South Florida this year an improvement overall, just generally speaking, in terms of being able to get coverage?
The answer is yes. There's a lot more coverage available.
We, yeah, we
There are
mentioned
more
this
companies
earlier.
writing insurance. There are the companies that had been here writing insurance have relaxed their underwriting standards. So the company that would a year ago would require a 7-year-old or newer roof will now write a 10 or 15-year-old newer roof. The company that would insure a home up to $500,000 will now insure a home up to a million or million and a half. So that there are more options. Part of the problem that goes with that is that a lot of the new insurance companies that are coming in are using some policy terms and conditions which are less than industry standard, and they're not particularly favorable to the policyholder. So while there are more options, you have to be more informed, and you have to be a more educated consumer to make sure that the options that are available, you're properly valuing them, whether they're a good deal or not.
Yeah. That's the thing. And clients are relying on people like you, Lee, to be able to interpret these, the wording of these policy to determine whether or not they're appropriate and that if a claim can be made,
Yeah.
which intentionally segues me on to our third question, which is why, and I'm sure this is a question you get, because you're the guy going out there getting the coverage and getting it in place. And then comes the other end of it, which is when the claims have to be made. So the question is, why do so many insurance customers seem to have problems getting claims paid? Lee, looking forward to your response here.
Okay. Um, I strongly believe that 80% of claim problems, claim issues, claim challenges start when a policy is written. It
I believe
starts at day one. And what do I mean by that? Uh, you're buying a house. The typical person, they're buying a house. They know insurance is going to be expensive. They start calling around to get quotes.
Mm-hmm.
They've got a lot going on. There's a lot happening in their life. They got to buy a house, move, finance it, and everything else. And are they spending any time getting quotes? They want to get as many quotes as they can as fast as they can.
And they're
So
looking for the best price too, a
they're
lot of
looking
the
for the best
times.
price. Are they exchanging information with the agent? Is the agent who wants to sell them a policy and make commission, but doesn't want to spend any more time than necessary? They're not asking any questions because if they can just ask the minimum questions and get a quote, sell a policy, they're happy to do that. So there's not an exchange of information. There may not be an open, honest exchange of information. Somebody may not be doing their part very well, very efficiently, very professionally. That happens all the time. So the information that's needed to do the job right, to get the right coverage in place, to make sure a claim is going to get paid, is simply not exchanged, shared, and then, of course, it's not communicated to the insurance company because the parties don't know it. So now the insurance company is insuring something they simply don't know. They don't have the information. Now a claim happens, and the claim is somehow related to some of this information that fell through the cracks. Okay?
Mm-hmm.
The insurance company, there are some insurance companies that simply don't like to pay claims. I will tell you,
I would think that
there,
that's the majority.
um,
I would think, based on my, I'm not just
I,
talking
I
about
would
P&C. I'm
say
thinking, I'm
there's a
thinking health
significant
insurance.
minority.
I'm
There's a
including the
significant
health insurance people in
yeah,
that as well, by the way.
well, yeah, the health insurance market. I'm the property casualty guy. I'm
I
not
know
gonna.
that. I realize that. Uh,
We haven't had any property casualty executive shot on the streets of New York recently.
thank God.
Yeah, thank God. I mean, that was terrible. That was terrible. Um, but the health insurance industry has got a reputation for some funky, business practices.
Yeah.
Um, there are property and casualty carriers that don't like to pay claims. There are a lot of property and casualty carriers that will also look at a claim very closely to see what they need to pay and what they have to pay. And then there are some carriers, there's some carriers that pretty much, particularly the private client carriers, they'll pretty much pay anything that's remotely reasonable. But they're also charging their pound of flesh for their policies.
Mm-hmm.
So the question, why aren't claims paid? It's generally because the job wasn't done right up front. Do the job right up front, and that claim is probably going to get paid and get paid efficiently. Now, there's also steps you need to do when the claim happens to expedite that, and that's a different story.
Yeah, I would just say, just as a follow-up question here, and just before we wrap up the podcast, it's more along the lines of, and I think you talked about this a little bit, just the proactive steps, which I think you're saying that the proactive activity is at the front end when you're purchasing the policy, because after that, it's kind of the horses out of the barn in terms, Lee, of being able to have much success. If you don't do that, if the policy isn't set up right up front, it's going to be really hard to have a lot of success when it comes time to make a claim.
Yes, and I'll give you a perfect example. You're a professional in the financial world. One of the core values and core obligations in your industry is a know your client. You
100%.
can you cannot do business with a client if you don't know your client. You don't know what their
KYC.
goals are, their objectives are. I mean, if you're regulated out the wazoo.
Yes,
There
and
is
it's
no
also
such.
important. Yeah, you're right. And I'd also add to that, and not even on the investment side, but also I'm licensed in life insurance, disability,
Yeah,
long-term care. When it comes to placing, for example, a life insurance policy where there's, you're paying a premium for a permanent policy and you're making contributions to the policy above and beyond just the usual premiums to pay for the death benefit,
right.
you need to adhere to that policy to the T. I've talked to people recently that funded uh, uh, didn't fund their insurance policy as it was illustrated, and they were disappointed to find out that this policy wasn't going to deliver what they initially set out. And they're obviously doing this, they're pointing the finger, but the reality of it is, you got to follow these policies and you got to basically execute them exactly the way they're drafted.
Yeah, no question. And I'm gonna kind of date both of us, but do you remember Hogan's Heroes and
Of
Sergeant Schultz?
course.
All right. Well,
Grew
I'm
up in
pretty
Bear River,
convinced
Nova
that
Scotia, watching Hogan's Hero at lunch.
a-
Yes, you name
absolutely. I'm pretty convinced that before the war and after the war, Sergeant Schultz was a property and casualty agent.
it.
And he was a very successful one because
I
he's
know
got the same
nothing.
I know nothing.
I know
I
nothing.
I know nothing and I don't want to know nothing because the less I know, the easier my job is. And I hate to say it, but but there's a lot of our industry that operates on the Sergeant Schultz value system.
I know.
I know
Well,
nothing.
uh, you know, I do remember when the chancellor for Germany had visited the U.S. And somebody played him an episode of Hogan's Heroes. He did not see the humor.
Oh no, no, no,
I
no, no. There's no German humor in that.
did not see the humor.
Yeah.
Uh, all right, I could go on Hogan's Hero rant here for a bit, so we'll pass on that and move on. Just to wrap up here, Lee, you've got decades of experience. You've served families, high net worth families, ordinary families. Uh, so, and I'm sure, lots of experience, lots of lessons. What would you say is the most critical lesson you've learned about navigating the insurance industry? Success, failures, the good, the bad, the ugly. And if there was just one last little nugget you could share with anyone listening in today that could help them ensure that the coverage they buy truly, protects them or gets them what they want, protects their wealth.
I would say, as silly as this may sound, apply some of the same standards to the people who are providing you insurance and advising you on insurance that you would to medical professionals or legal professionals. If you walked into your doctor's office and the doctor didn't ask you questions, ask you about your history, ask you what was wrong, ask you how you felt, ask you what was going on. If they didn't run some tests, if they didn't take time, they didn't talk to you, they didn't have a good bedside manner. Maybe you'd keep them as your doctor, but you wouldn't be very comfortable and you wouldn't be very certain that you were getting good medical care. The same thing would apply to an attorney. Same thing would apply to virtually any professional.
Same
But when
for
it
us. I
comes
mean,
to
we
it,
have to do very detailed discovery when we're doing meeting with a client for the first couple, like it's an
yeah,
inquisition, essentially. We have to ask a lot of, I call them nosy Parker questions. You have to do your discovery, you have to do your due diligence.
yeah. I mean, now what's the image of the insurance industry? Go online and in 5 minutes we'll help you save 15% on your auto insurance. Well, okay, is there any degree of professionalism? Is there any degree of know your client? Is there any degree of of anybody remotely thinking that things are being done right and people care? The internet doesn't care. The internet doesn't care about anything other than doing that transaction.
Sure.
And I'm not dissing the internet. It's got its place, but the same thing happens with human interaction. Do business with people you know,
Yeah.
like, and trust.
Yeah. Yeah. The transactional based relationships, and you get what you pay for.
Yeah.
Lee, just as we wrap up here, we're recording this. There's obviously a video. We can both see each other here, but also there are a lot of people who are going to be listening to us on Apple, on Spotify podcasts that are not going to be able to see the fact that we've got your contact information under your picture here on the video. So for those folks listening and they say, well, I wouldn't mind talking to this guy. What's the best way for them to contact you? How can they get a hold of you?
Well, my name is Lee Burke. I'm president of Burke Bogart and Brownell Inc. In Boca Raton, Florida. Um, my email address is lburke, Burke, at bbbins.com. Give us a call to the office. We have a toll-free 800 number. It's 800-332-9044. Or our main number is 561-392-8888. give us a call. I'm here. I'll get back to you if I'm fortunate enough to be up in my house in Nova Scotia. I'm still working from up there. Wayne, we love to answer questions for people. We love to help people. That's our first objective. So anybody that's got a question, got an issue, give a call and ask a question. We'll take some time to answer it, try to help you, no charge, no obligation. We think that's a professional responsibility that we have to as professionals and certainly to our neighbors and friends and to the community.
Well, Lee, thank you very much for joining us today. It was great having you as a guest. Great conversation. We covered a lot of topics, and really appreciate you making time for us today.
Well, thank you, Wayne. I enjoyed it.
Lee Burke joined us from beautiful Boca Raton, Florida. I look forward to bringing you to the Three Questions podcast, and I do hope you find them educational and informative. Please consider liking this video and subscribing to our podcast and YouTube channels. And to receive a notification when our latest episode has been posted, please click on the notifications bell. Last but not least, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you, and we'll see you soon.